Have you ever noticed how price sometimes touches a level perfectly, reacts for a moment, but then suddenly reverses and wipes out everything? What if I told you that the reason isn't randomness, but something hidden inside how order blocks and liquidity actually work? In this part, we're going to uncover one of the most overlooked truths about market movement: why some order blocks hold strong while others fail. Welcome to a new section of the Smart Money Concepts course. In the previous part, we learned what order blocks are and mentioned that any candle meeting these four conditions can be considered a valid order block. It must cause a break of structure or a change of character. It must remain unmitigated. It must be accompanied by a fair value gap. And on the entry time frame, it must form as a result of a reaction to or a break of a higher time frame order block. Now, in this part, we're going to dive deeper into the more advanced and professional aspects of order blocks. We'll learn how to determine which order block among several is more valid, how to find more zones by understanding the difference between fair value gap and inefficiency, how to use the concept of the 50% level of an order block, how change of character can sometimes form from the break of an order block itself, the meaning of a flip, and when order blocks become invalid, and the difference between how they're invalidated on the entry time frame versus higher time frames. Section 1. Validity of an order block based on fair value gap size. One of the key factors for determining the strength of an order block is the size of its fair value gap. When a strong move occurs in the market, a gap is often left between candles. This is called the fair value gap. The larger this gap is, the greater the imbalance between buyers and sellers, and therefore, the stronger and more valid the order block that caused it. So when you're unsure between multiple order blocks, the one that created a larger fair value gap will usually be the more reliable zone for price reaction. For example, if you look closely at this part, we have two order blocks. One is this candle, and the other one is a bit lower. But if you measure the distance between the candles, you'll notice that the lower order block has created a larger fair value gap. That means this zone had more strength in changing the market's direction. So, in such situations, we usually prefer to take our entry from the order block that has created a larger and clearer fair value gap, because the probability of a price reaction to that one is much higher. Keep in mind that a fair value gap isn't just a simple gap between candles. It's actually a sign that the market has moved in an imbalanced way, and that banks or large institutions haven't yet returned to that area to complete their orders. That's why, when the price revisits that area, we usually see a clear reaction. Section 2. Difference between fair value gap and inefficiency. At first glance, fair value gap and inefficiency look similar, but they're slightly different. A fair value gap forms when there is no overlap between candle bodies, while inefficiency refers to any area where price moved too quickly and didn't fully balance. So every fair value gap is an inefficiency, but not every inefficiency is a fair value gap. Understanding this difference helps you find more valid order blocks, because sometimes market makers use smaller inefficiencies for reversals. All right, pay attention here. We can see a shadow that has taken out the low of the previous candle. Now the question is, why can this very shadow be considered an order block? Look, this shadow is actually where the liquidity below the previous low was taken. The market dropped down, swept that low, collected the liquidity, and then started a strong bullish move from that exact point. This means that the shadow is, in fact, a sign of the entry of strong buyers. So we can say that the last sell before the start of this bullish move, meaning this shadow, has turned into a bullish order block. Now here's another important point. The rectangle I drew between this candle and the first bullish candle represents the area of inefficiency, also known as price imbalance. This means that in this range, the market moved quickly, and there was no real exchange between the bid and ask prices. That's why, usually, after a bullish move, the price comes back to fill this inefficiency zone. All right, pay attention here as well. We can see that the low of this candle's shadow and the low of the previous candle shadow are placed exactly at the same price level, meaning both are aligned on one level. Now the question is, in such a situation, can this area that we marked with a rectangle still be considered an inefficiency? so that we can check off the inefficiency criterion and consider this zone as an order block for entry? The answer is yes. However, there's an important difference here. When the lows of the shadows are positioned exactly on the same level, it means the market hasn't completely taken the liquidity below that low. It has only touched it. As a result, the strength of the move that follows is usually weaker, and the validity of the order block also decreases. That's why, in such cases, it's better to use a confirmation-based entry method in two possible ways. First, if this reaction itself comes from a zone that caused the break of a higher time frame structure, or second, wait for the price to reach this order block, show a clear reaction, create a change of character, and then enter. But in this particular case, with this beautiful formation of liquidity, it's quite safe to take a risk on this order block. Section 3. The 50% of an order block. Sometimes, the price may enter an order block and mitigate part of it, but not fully reach inside. This is where the concept of the 50% level of the order block becomes important. If the price only touches a portion of the order block and the 50% level has not yet been mitigated, that area can still be considered valid, and any break or reaction from the remaining 50% zone becomes significant for us. Here, we have an example of a bearish scenario. The price moved upward, entered the order block, reacted to it, and created a setup for us on the entry time frame. But it only mitigated a part of the block and did not yet reach the 50% level. In such cases, the half of the order block that has not been mitigated yet still remains an important area for us, but specifically only the 50% level, not the entire unmitigated portion. Later, the price came down and broke that 50% level, and this break again created a setup for us on the entry time frame. So, both the reaction from that area can give us a valid reversal, and if the price breaks through that remaining 50% level, that break itself can indicate the loss of strength in that order block, showing that the order flow might be shifting, and once again, it can generate a potential trading opportunity for us. Therefore, both the reaction and the break of that level are important. Section 4. Change of character from breaking an order block. Usually, a change of character forms when price breaks a major swing high or low. But sometimes, it happens simply by breaking an order block. If an order block acting as support or resistance gets broken, that break itself signals a shift in market structure, even if no major high or low has yet been taken. Section 5. The concept of flip. A flip refers to a situation where an order block transitions from demand to supply or vice versa. In simple terms, it is a point where previous buyers become new sellers or the opposite happens. As a result, identifying flips helps us spot new zones for potential entries, targets, or market analysis. Zones that are often overlooked by regular traders. Here, we can see a clear example of the flip concept. At first, the price touched this area and reacted to it, meaning it was a valid order block at that time. But what happens next? The price breaks through this area, and after that break, this same zone turns into a new order block for us. In other words, what was previously a bearish order block has now transformed into a bullish order block. This is where we say that the zone has flipped from one type to another. So a flip simply means a change of role, where demand becomes supply or supply becomes demand. And in this example, by identifying this flip and noticing the break of its low, we can recognize the change of character much earlier and take an entry based on this new flipped order block. Section 6. Order block validation based on backtesting results. This section is built upon insights gathered from backtesting. On the entry time frame, if we are considering an order block as our potential entry zone, as long as the price moves up to 2.2 pips beyond the 50% level of that order block, it is not yet considered invalidated. However, if the price moves 2.3 pips or more beyond that level, the order block loses its validity for us. You might remember that throughout the course, we mentioned that we only trade on the euro-dollar pair. Therefore, this 2-pip stop rule applies specifically to this pair. We also allow the price to move 0.2 pips beyond our stop to compensate for minor system or strategy errors. For example, in this particular position, the price moved 0.2 pips beyond our 2-pip stop, but then reversed and provided a large take profit. Now let's move on to higher time frames. On a higher time frame, an order block remains valid, as long as the price has not broken it with a candle close. In this case, the shadow wick can move as far as it wants beyond the order block. But the moment a candle closes, even 0.1 pips beyond the boundary of the order block, that order block is considered invalidated for us. In this video, we learned that the concept of an order block goes far beyond just spotting a few specific candles. From now on, when you look at the chart, don't just look for potential reversal zones. Focus on the logic behind each price movement, because that's where the real smart money perspective is formed. If you found this video helpful, make sure to like it so it reaches more traders. And share your thoughts about these concepts in the comments. Until the next video, backtest with focus and trade smart.